And we're going to get started on 1031 tax-deferred exchanges. And so the key questions I intend to answer with this presentation today is, what is a 1031 exchange? Does anybody know what a 1031 exchange is? Raise your hand if you know what that is. Raise your hand if you've done a deal with a 1031 exchange. All right, good. We have some people who actually have some knowledge. I'm going to go over the basic rules, but then we're going to get into some complex and creative scenarios on 1031 exchanges. So if I ask later on if you've done a reverse exchange or a consolidated exchange and you've done all that stuff, I'll be really impressed. So hang out to the end, you'll really get some value at the end if you actually know what an exchange is. But in order to understand how 1031 exchanges work, you have to understand what is a capital gain in general, okay? So we're going to start with that. Then we're going to talk about the requirements and some practical examples of those things. And then we're going to talk about some more complex exchange strategies, all right? And this is a 2-hour class with 3 10-minute breaks, and I'm not going to take the break, so it will be no longer than an hour and a half. And I will probably go faster than that. So y'all hang on tight. We're going to get through this efficiently and with some good quality. All right, so some of the key players that I want you to know in a 1031 exchange. And these are the people that you're going to be likely engaging and dealing with as you go. And so I'll skip the first one. A title company is pretty simple, right? A title company is the one who's going to be closing on not only the first transaction with the relinquished property, but also closing on the replacement property. It doesn't have to be the same title company. It oftentimes is more efficient and helpful if it is. You need to meet with your CPA because there are costs for 1031 exchanges, and sometimes if your savings don't outweigh the cost, and so it might be more beneficial just to go forward with a traditional sale and use the after-tax money to invest or buy your groceries. You need a good real estate agent. I know y'all know this, but it's important that this presentation for you guys to understand what these things are, because in your role in a 1031 exchange and how you need to serve your clients, because there are a lot of time requirements, a lot of requirements for these in general, and so you have to understand those things to make sure that you can service your clients well and make sure they don't miss out and have to pay taxes when they didn't intend to. And the first one is the QI, which is the qualified intermediary, and we're going to get into very specifically what that is. But your title company, your lawyer, your CPA, your real estate agent, and oftentimes should not act as your qualified intermediary, and we'll go into a lot of detail of why. All right, so this is the most crucial party of any 1031 exchange. The role of the qualified intermediary is to manage the money for the transaction. So they're going to hold the money between the two time periods, and they're going to be there to help you walk through the process too. They should be, along with your realtor, helping you make sure that you meet all the time requirements and the delays and make sure that everything's met. And again, we'll go into that in more detail in a second. All right, so let's talk about what is a capital gain, right? If you're a grown-up and you've sold any assets, you've probably heard the term before, and your CPA's probably talked to you about what a capital gain is. But let's do it assuming that you didn't know it. A capital gain is the profit you make when you sell an asset for more than the original price. All right, and that can apply to anything, not only immovable property or real estate. Capital gains applies to selling stocks, bonds, anything like that. Any type of investment, generally speaking, is going to have a capital gain associated with it. So when you're calculating the capital gains, it's generally and basically going to be the difference between what you bought something for and what you sold it for, okay? And there's going to be some key terms that we're going to go over, okay? One of the main terms that you have to understand is that term basis. Does anybody know what a basis is and what basis means? All right, I'm teaching everybody something today. Great. So your original basis is going to be the price you paid for that asset, okay? So if you bought an investment property for $100,000, your general original basis is going to be the $100,000 that you put into that, okay? And that key term is important because, again, your capital gains are going to be the difference between what you sell something for and the original basis that you paid in that deal. And we'll have some actual hard examples in just a second. Your adjusted basis is going to be all the other costs associated with that asset. So that will include any capital improvements that you make in the house. If you put a new roof on the house, if you paid closing costs, you pay a real estate agent. All of those different things go into increasing your basis in that property. Does that make sense? If I buy something for $100,000, I pay a real estate agent $10,000. My basis is not the original $100,000; it's $110,000. So if I sell something for $150 that I bought for $100, and plus I pay $10,000 in real estate commissions, My basis is not $50,000, it's $40,000. Okay, does that make sense? And your capital gains is based on the difference between what you sell it for and your basis in that property. Okay, so when people come up to you and say, should I do a 1031 exchange, it's important to know that if you're just looking at the difference between what somebody bought something for and what they sell it for and the tax savings, that might be important. But if you add all of those other things in there that increase your basis, there may be no capital gain at all. So you need to know those things. And I think it's important also that we reference back to knowing a good CPA that you can reach out to talk about those things. And you need to encourage your clients to have a good CPA as well. No need to smile, Gigi? Yes. Yeah. All right, so again, we talked about the capital gain calculation. It's going to be the sales price minus your basis. That's the basic equation. But you need to add to your basis. If you remember your algebra problems and when you were growing up, if you're calculating your basis, you're going to put a parentheses around those numbers. If you're doing a math problem, it's going to be the sales price minus parentheses, add all the things that you put into that house, close parentheses and equals, and that's going to give you your actual capital gain. That make sense? Okay, so in our capital gain example that we have here, and it's actually in y'all's workbook, I think. It might be a little different than what I have on the screen. But let's say your original basis in the property is $250,000. Okay, that was your purchase price. You added a kitchen, a deck, put some sod in, a fence up, replaced the roof, got the house cleaned, and that all cost $50,000. Your adjusted basis is now $300,000, right? So if you sell your house for $500 and your adjusted basis is $300,000, you're going to pay capital gains on $200,000. That make sense? Pretty simple stuff. So there's two types of capital gains. All right, you have your short-term capital gains and you have your long-term capital gains. And in y'all's workbook, there's actually a graph there that shows, the graph that shows you the difference in the short-term and long-term capital gains. And you can see that it can be quite a drastic jump. So your short-term capital gains are assets that are held for less than 1 year. So your real estate investors that are into flipping property, those are going to be short-term capital gains because they held those assets for less than a year. Your long-term capital gains are going to apply to those things you hold for over a year, and your capital gains is going to be substantially lower, between 0 and 20%, as opposed to between 10 and 37%, which is going to be quite a jump whenever you're considering, how long you're going to hold the assets and what your capital gains are. Okay? My graph. All right, so now we're going to talk about the difference between a capital gain exemption and a capital gain deferral. Okay? So a capital gain exemption means that I am exempt from paying capital gains. That means in this transaction, I do not have to pay capital gains at all. That make sense? Everybody shaking their head yes? A capital gain deferral means that I am going to have to pay capital gains at some point, but I don't have to pay it right now. Okay? And that's an important thing to remember, is I'll get a call all the time from somebody that says, I want to do a 1031 exchange. And I ask 2 or 3 questions before we even get into what a 1031 exchange is to make sure that we're talking about a capital gain deferral and it doesn't qualify for an exemption. Because a lot of times you're going to find that the property may qualify for an exemption if you don't really understand the difference. Okay? So we're going to go over 2 common capital gain exemptions that you need to know about. So you can tell your client 1031 exchange is not needed because we're going to be exempt from capital gains instead of having to defer them. All right, the first one is the primary residence exception. Okay, everybody's heard of that exception, right? Everybody knows that exception is the rule. You'd be surprised on how many real estate agents call me and say, my client wants to do a 1031 exchange, and I ask them, did your client live in it as their primary residence? And did they live in that property for 2 out of the last 5 years? If the answer is yes, exempt from capital gains. Okay, there are a few caveats to that. 2 years means 24 months. Okay, that does not have to be a consecutive 24 months. So I can live in the property for 12 months, move out for 2 years, move back in for 12 months, sell that property within that 5th year, and I am exempt from paying capital gains. It does not have to be a consecutive 24 months. Okay? Another thing that we're going to talk a lot about is, I've had questions from people, and it is an interesting argument to make that, well, my client actually had 2 homes. They lived in the mountains in the summertime, and they lived in Louisiana during Mardi Gras season. And so what the IRS is going to look at is practically where was your primary residence, right? They're going to look at a litany of factors, and I can send it to you, and there's really not a definitive number of factors. It could be anything. They're going to want to know where your mail went, what's on your driver's license, where did your kids go to school, where was your doctor that you visited? Were they were they in that town that you lived in Louisiana, or were they in Colorado, right? So they're going to look at all of those different factors to determine whether you lived in that house as your primary residence or not, okay? I am not a CPA. Did I say that already? No, okay, well, I'm not a CPA, okay? I don't file people's taxes, but I will say that ultimately, if you finding the right CPA, finding the right attorney, finding the right companies to partner with, real estate agents, whoever, you have to know what your risk tolerance is and your client's risk tolerance is before they can make a decision, right? And so whether somebody qualifies as living in it as their primary residence, there's factors that weigh for and against that. And if they're 50-50, whether the Colorado house was or the Louisiana house was their primary residence, they make the decision on whether they're going to file their taxes as an exemption in that scenario when they sell their primary residence. And if the IRS knocks, they're going to have to be the one that proves that it was their primary residence, right? But I want you guys to understand what factors go into it so you can have that conversation and kind of help them gauge whether they're going to take the risk of saying, well, we're going to take all this money, apply this exemption, and not file not pay capital gains on that. Does that make sense? Okay. And look, Marcus talked about ChatGPT. You can go to chat and say, hey, what is the IRS going to look at to determine whether this is going to be my client's primary residence? And it'll give you a litany of things to consider, okay? So primary residence exemption means that if somebody qualifies, they do not pay capital gains up to $250,000 in gain. If you're married, it's $500,000, right? Not often around here does somebody have $250,000 in gain, but it can happen. I've seen crazier things happen. So that's the capital gains on your primary residence exemption. And this is a scenario. So they bought it for $3, sales price was $8. They have a $500,000 gain as a married couple, and they lived in it as their primary residence. They're going to be exempt from paying capital gains because they meet that standard. Okay? Everybody understand that? Make sense? Who didn't know that? Who did I teach something to today? Raise your hand. All right, Sawyer, I know you knew that guy. The smartest man in the room is sitting in the back with that handsome beard. All right, another capital gain exemption is something that you may not have heard of. It's called a stepped up basis. And this applies when somebody inherits property from somebody else. Tracy? And so when somebody inherits property from somebody, they're going to get a stepped up basis under the IRS IRC 1014, and that's going to allow them to be exempt from paying capital gains in that scenario, okay? And so I think that an example early on in this is going to be helpful. So let's just say that somebody's family member bought the property for $200,000, okay? And then they sell it for $500,000. They're going to have a $300,000 capital gain in that scenario, right? Now, if that person who bought the property for $200,000 passes away and their heirs inherit that property, okay, and at the person's death, the property was worth $500,000, okay? The IRS allows the basis, which is what that calculation we talked about earlier, to step up to the value of the property at that person's death. So the basis in that property goes from the $200,000 when they originally purchased it to $500,000. And if the heirs take that property and sell it for $500,000, they're going to get to take an exemption in that scenario and not pay capital gains on that sale. Does that make sense for everybody? Okay? A lot of times, if you inherit property and sell it quickly, you're going to have real estate commissions. You might have to put some work into that house, right? So that's going to increase your basis. So if your basis was $500,000, because that's what the value was at their death, and you add $50,000 to the adjusted basis, now it's $550,000, I sell it for $500,000, I might be able to take a loss on my taxes for that year. All that make sense? So those are two examples of capital gains exemptions that we see often. And I'll be in a closing room, and it's funny how many people don't have CPAs. But I will tell people, like, if you're selling inherited property, this year, if you've never filed taxes with a CPA, it's a smart thing to do. Because I'd hate for you to go to TurboTax and push two of the wrong buttons, think you have to pay this big capital gain bill when you could have avoided that by paying a CPA a couple $100. Hey, Cav, gotta get a water. Thanks, buddy. All right, so those are the two capital gains exemptions. All right, stepped up basis, we went over that. Case study on capital gains, results, review questions. All right, now we're going to get into our deferral that we're going to talk about, okay? This is a 1031 tax-deferred exchange, okay? And a 1031 exchange, it was created, and I have some history here if you're interested in understanding when it was created and why. But it was created by the IRS to allow real estate investors to take the money that they make in a real estate transaction and use that to buy something else without having to pay capital gains on the money that they make from that sale at the time of the sale, okay? The trick is, thanks buddy, is that ultimately as a deferral, you're gonna pay the capital gains at some point, right? You just don't have to pay it in that transaction there. So you can use all the proceeds from your sale to go buy another piece of real estate, okay? And if you paid attention to the exemption that we just talked about, the stepped up basis, some of the wealthiest people and families in the world use the 1031 exchange strategy to acquire properties and get larger and larger assets that ultimately pay for their lives. They pass away, their children inherit it, they get the stepped up basis, the children sell it, and they don't pay any capital gains. Does that make sense for anybody? So a great real estate investment strategy if you think long term about how you can use real estate to create generational wealth for your family, okay? So 1031 exchange is a great tool. I love talking about it. If you read any books about real estate and about taxes, this is going to be one of the main tools they're going to talk about. If you're interested in books, the Tax and Legal Playbook was one of the books I read early on in my business career, and it is very basic, high-level ideas because you don't have to be an expert at these things to be able to go talk to your CPA and talk to your other professionals on how you can set these things up. And then there is a Tax-Free Wealth. It's one of the Rich Dad, Poor Dad series, not written by Robert Kiyosaki, but it's a great book about how real estate investors use real estate to avoid paying taxes. Tax-free wealth, yeah. All right, so what is an exchange? We talked about it's a deferral, okay? It allows you to defer paying capital gains until later on. So if you do a 1031 exchange on a deal today, and then you sell the property that you purchased from that exchange later, you're gonna pay capital gains on that transaction, assuming that you don't do another 1031 exchange, okay? So how does it work? You're going to need all the parties that we talked about earlier today. And those parties are going to be involved in facilitating all of these guidelines that I'm about to go over, okay? And there are 5 main guidelines that you have to follow and you need to know in order to do an exchange. So you have to buy like-kind property. I'm going to go into all these in detail. There are 2 major time delays you have to meet in order for you to qualify for an exchange. You have to use a qualified intermediary. The property has to be equal or greater value, and you have to be the same taxpayer that sells the first property, which is called the relinquished property, and buys the replacement property, which is the second property, okay? I gave you some context on those at the front, but I'm gonna go over those in more detail. So, all right, the first one is the like-kind property requirement. I should have put page numbers on this thing so I can tell you what page I'm on. It's the requirement, it's section 3, requirement 1. So, like-kind properties. A lot of people will call and ask, what qualifies as a like-kind property? So in order for you to be able to use an 1031 exchange, the property has to have been used for business, trade, or investment purposes, okay? That means you have to have the intention of buying this, of using this property that I'm going to be selling for investment reasons. It can't be a second home that you primarily use as a vacation home. It can't be your primary residence. Again, that the exemption usually applies in that scenario. It has to be something that you use for investment, okay? I'll also get the question, does it have to be the same type of asset? The answer is no. Real estate is real estate. You can buy you have a piece of land that you sell, and then you convert that into multifamily. You can take the multifamily, you can buy commercial. You can go back to a vacation rental. You can use it as a short-term rental. You do not have to use the movable property for the same reason as you used it before, but it's got to be real estate. Other assets don't qualify for a 1031 exchange, okay? At one point in the past they did, and then they changed the rules, and now you have to use it. It has to be real estate, and it has to be used for investment purposes. It cannot be considered personal property, okay? There are some nuances to it, and we'll get into that in a second. There's something called a drop and swap. Anybody heard of a drop and swap? It's, again, complex type of stuff. That means you've held property in an LLC with another partner, y'all sell that property and one of the partners wants to do an exchange, the other one doesn't, okay? And then there's ways to get around that, but you have to think about that well in advance, and we'll go over that in just a minute. All right, and so intent is huge, right? Again, you have to have intent, and the IRS is going to look at several things. Again, there's not a definitive rule and list of things the IRS is going to look at to determine whether the intention that you had was to buy investment property, right? But they're going to want to know, did you have a long-term lease on this property, right? They're going to want to know if it's a rental in Florida, how many days did you actually use that property for yourself or use it for income-generating purposes? How long did you hold the property, right? They want you to have it for over a year, right? At least a year, more than likely 2. Okay, you can't just buy something for a year and a day. You might get away with it. The IRS might knock on your door and ask for you to give some more evidence of your intention of using that as an investment property. Okay, so the longer you hold it, the better. It's super important. Oh my God, my 7-year-old's about to come busting in here. So documenting your leases and making sure. Can you let her in? I want to give her a hug. So using it to flip. She said no. Heck no. She knows me too well. My 5-year-old though, her ass will be in here on stage helping me give a presentation. My son too. So intent's important, and making sure that you're doing everything the right way. You're tracking your numbers, you're making sure you're saving your tax returns, you have your lease agreements in place and all of that. Those are all very, very important. And business plans too, right? Hey, sweet girl, I love you. All that stuff's super important. She has one more day of school. All right, and so we talked about, again, property classifications. It does not have to be a short-term rental for short-term rental. It can be any type of reason that you use real estate as long as you have it used for real estate. But it does not apply to rental equipment like your car, your tractors, all that stuff for your business. Those things do not qualify for a 1031 exchange. It would be considered personal property. If it's not real estate, real property, if you remember when you took your, get your real estate license, that real property is the movable properties that you buy. Rental versus personal use. This is one of the factors the IRS is going to look at, okay? If you rent your secondary home for more than 14 days a year or 10% of the time you use it personally, those are kind of rough guidelines for you to determine whether it's considered a rental property, used for business purposes or for personal use. So you need to at least have documented 14 days a year or 10% of the time you use it. So if you use it for 300 days, you need to have rented it out for 31 days. That was good math right there. And I had a margarita already. All right, so I have some review questions if y'all want to go over that. Like, what type of property qualifies for a 1031 exchange, right? What type of property is that? Real property, exactly. And intent is a big thing. We'll go over intent a lot in this conversation. And we have a case study. Sophia is an investor in New Orleans. She owns a single-family rental property she purchased 5 years ago for $250,000. It appreciated to $4,000. Now she wants to do the 1031 exchange. Will she qualify if she wants to buy a new rental property? The answer is yes, because she is using it for business purposes. Rental for a rental. All right, let's flip through here. So the timeline. So the second requirement that you have to know for a 1031 exchange are the very, very important timelines that have to be met in order for the IRS to allow you to defer your capital gains till later, okay? And that's going to be section 4. So the two most important timelines you need to know is the 45-day rule and the 180-day rule. So the 45-day rule states that you have to identify up to 3 properties as a general rule within 45 days of you selling the first property. Okay? So the date that you sell and you close on that first property, you have 45 days to start identifying. And there's actually 3 identification rules the IRS allows. The most common is that you have to identify up to 3 properties, okay? So what you're gonna do is your qualified intermediary is gonna be holding your money, and you're gonna reach out to them within that 45 days, and a good qualified intermediary is going to follow up with you and make sure that you identify those 3 properties and document them. And then you're going to have the 180 days from the sale of the original property, right? Not after the 45 days is over, but 180 days from the original sale to buy 1, 2, or 3, all 3 of those properties you identified. Go ahead. You don't qualify for 1031 exchange.
So what if you're under contract and then like something happens at the last minute?
You have to pay capital gains. Yep. So it's important. A lot of people, a lot of investors, like we've done 1031 exchanges to where we'll close on the relinquished property and replacement property on the same day, same week, because they already know what they're buying. And you can get them both under contract at the same time. No reason why you can't. But if you don't meet that deadline, that 45-day rule, then you lose out on the ability to take advantage of the capital gain. That means if you miss, go ahead.
So the count for 45 and 180 starts the same day?
The same day, exactly. So the closing of the 1031 exchange has to happen 180 days from when you sold the relinquished property, right? We talked about definition. We talked about basis was the first definition. Second definition is relinquished property. That's the one that you own and that you sell. And the replacement property is the one that you buy. And you have 180 days from the sale of the relinquished property to buy the replacement property, okay? So if you don't meet the 45-day mark, even if you close within 180, you still are disqualified for an exchange because you didn't meet the 45-day mark, okay? So it's important that you and your qualified intermediary are on the same page, and you've done the research beforehand more than likely to identify the properties you want to buy. Now, I said you have 3 properties. There's actually 3 different rules on identifying property we'll go over. The general one people use is the 3 property rule. So you can identify up to 3, okay? The other rule is the 200% rule and the 95% rule, okay? So the 3 property rule, again, you can identify up to 3, and you have to buy at least one of those to use for your exchange. The 200% rule, which I honestly have never seen anybody actually take advantage of this one, but that states that you can identify up to as many properties as you want, as long as the total value of all of those properties are not greater than 200% of the value of the one you sold. So if you have a rental property that for $200,000 for $1 million that you sell, they've identified in this example 4 properties that you're looking at. The total amount of those things are 1.2 million. That is within 200% of the property you sold, and so that will qualify. You have met the identification 200% rule if you do that. Now you have to actually purchase one of those identified properties within the 180 days to qualify. You can't go outside of those, in this example, 4 properties. The other property, the 95% rule, which is not very common because it's a very hard benchmark to meet, is that you can identify as many properties as you want as long as you purchase 95% of the properties that you've identified. So if you identify 10, you have to buy all 10 of those to meet the 95% rule. Just simple math, right? You buy 9 of them, you're at 90%. So there are ways for you to identify more and give you a greater chance of closing on one of the properties, but these rules, the 200% rule and the 95% rule, are very nuanced, and you have to make sure that you meet these standards. And if you don't, again, you're paying capital gains. So you have to make sure that you're doing your due diligence on the front end, that you're actually completing the exchange under this guideline very, very particularly. Okay, and then we talked about the 180 days. So you have to actually close on that replacement property within that 180-day mark. Anybody have any questions about that?
Yeah, when you had the 200% rule and the 3 properties, or was it the one before? Did you have to buy all 3 of those properties?
No, ma'am.
Or
Just one of those. That's why a lot of people will use that rule, because it's easier for you to hit that number.
Because I always thought you had to buy at least the value of what you sold.
Yes, we'll go over that in a minute. That's one of the other 5 requirements. Yeah. And so that again, when you're doing all of these numbers, you have to make sure that you're identifying and you're choosing and you're buying properties that meet all these standards. This is just the first one. Go ahead.
What if you've identified 3 properties that have a property?
If you'd have to meet the 200% rule, that as long as the 4 that you, and if you've identified within 45 days and the 4th property doesn't push you over this limit, then you're good.
What if it's after the 45 days?
You cannot buy that property. Well, if you buy that, you will be required to pay capital gains on the sale of the first. So you have to meet this standard within the 45 days. All right. Any other questions about the identification rules?
So qualifying means having on the contract within those.
No, you just have to identify them. You do not have to have them under contract. You just have to let the qualified intermediary know in writing that I'm buying. These are the properties that I've identified that I'm going to take and use as my replacement properties. Yep. You do not have to have them under contract. But the question was, do you have to have those properties under contract? The answer is no. You just have to have in writing identify those with your qualified intermediary. Whitney?
What if there's a group of investors that are buying an apartment
Mhm.
and then the apartment complex sells? How are each individual, say there's 10 investors, are they all exempt from capital gains?
Section 7, requirement number 5, same taxpayer rule. We'll cover that in that rule. But the answer is maybe, and the classic lawyer answer. So she asked if there's a group of investors that wants to either sell or go into another deal on the purchase, will that qualify for an exchange? And we'll go over that when we get to the same taxpayer rule. But it can, but it doesn't always qualify. Any other questions about that? Okay. So a case study. If you want to look at the case study, you can. I'm not good at reading with a bunch of people watching me. Y'all see me do closings all the time, but I still hate when people are watching me while I'm trying to read something. But I mean, simple case study. If you identify, on January 1st, if you sell a piece of property, by February 15th, 14th or 15th, how many days are in January, you have to identify properties you want to buy under one of the 3 rules, and then within 180 days, so sometime right between June and July, you have to have closed on those properties in order to take advantage of the exchange. Okay, that is the first and the simplest of the rule. I do have a 10-minute break, which I'm going to keep rolling right through the break. Keep going, guy. I figured everybody's ready to keep on rolling. All right, so the second requirement is the role of the qualified intermediary. This is a pretty simple rule on its face. So a qualified intermediary is a third-party company whose job is to have you sign all the necessary documents for an exchange. And at Arena Escrow, for example, we have a bank account that holds the money between the sale of the relinquished property and the purchase of the replacement property. I've had at the closing table where somebody said, I want to do a 1031 exchange as I'm handing them the check. Okay? If that money goes into the seller on the relinquished property's bank account, they are disqualified from an exchange. The money cannot go into their account. If it touches their account, they are no longer allowed to do that. So I literally, last week, somebody said, I'm thinking about doing an exchange. As I'm handing her a check, I'm like, I can hold on to this in my bank account for the next 48 hours while you go talk to your CPA and decide whether you want to do this. And if you decide you want to, I can open up an account with Arena Escrow, put the money in that account, and you can move forward with the exchange. But if I give you this check and you put it into your account, you cannot do this anymore, okay? And that's the role of a qualified intermediary. They want to make sure that the money doesn't get commingled in your account, and they're going to hold on to it to make sure that you can use that property for the replacement property. Use that money for the replacement property, okay? Other things a qualified intermediary is going to help you with is they're going to help you manage this process, right? If they're a good intermediary, they're going to help you with this process. They're going to give you the rules. They're going to follow up with you. They're going to give you all the necessary paperwork. And these are all the real reasons why, right? So they're neutral third party. They manage the escrows. They know the compliance. They know the regulations associated with it. There are a lot of good qualified intermediaries out there, right? Go ahead, Steve. You got a question? They technically they can, and we've thought about doing that, and we're still working out the logistics for that for us. But not every think about it practically as a qualified intermediary. Most of the time they have one account for all of their stuff, so it's harder for you to earmark that. One of the sponsors today, B1 Bank, actually has a product that allows you to put everything in one account, but earmark the money between different people, and you might be able to. We're working on maybe be able to collect interest for our sellers, but that's in the works. So. Generally speaking, no, but there's a possibility that you can. He asked if you can collect interest for the money that's in the account during that time period or not. There's a couple things I want you to think about, and you need to ask these questions if your client's doing a 1031 exchange. Like I said, if the seller of that first property puts money in their pocket, in their bank, then they're disqualified. Sometimes, and the IRS can see that if a law firm works as a QI, qualified intermediary, and they also have clients that they manage, that receiving that money and putting it into their escrow account could be seen as taking the money for their client and holding on to it for their client. It could be a form of acceptance and deposit for a client. And the IRS could look at that and say, you disqualified from an exchange because through your fiduciary as a lawyer, they put the money in their account and you're disqualified. Which is a big reason why we separated our law firm and our escrow company because we wanted to make sure that we didn't get in the way of commingling those funds. So it's an important thing to ask, is this qualified intermediary an individual company that's not helping you in any other way? Some CPAs will do the same thing. They're accountants, they may be able to be a qualified intermediary, but if they handle your finances and your taxes for you, and they put the money in their account, they could be seen as accepting that money on your behalf, and you could be disqualified. So that's a nuance that you need to make sure that you pay attention to, and some law firms and CPAs don't know that, or they haven't had that happen to them, and it could be a pretty catastrophic event in the case that their client has to pay capital gains if they would have otherwise just put it into a different entity account. Okay? Does that make sense to everybody? Make sure that you're paying attention to that if you have a client that is trying to choose who their qualified intermediary is. All right. And the process of working one is pretty simple. We like to tell people that you need to get with your QI as early in the process as you can, because it takes time to organize the bank accounts, right? If I get somebody at the closing table that says, I want to do an exchange, right? And we're all scrambling to get everything organized because there are some documents that have to be signed at the closing for that to take place, right? And so having that conversation, if you know that your client meets the like-kind property rule and they did live in it as their primary residence and they may be wanting to buy another piece of property, ask them, have you considered a 1031 exchange? When you get that property under contract or before you even list it, so that you can get them connected with the right people in the case they want to take advantage of that. Okay? All right. So the next rule, which is let me see which rule I'm on now. The fourth requirement for a 1031 exchange is the greater or equal value rule. And I will have to admit this one can get complicated. But there's two things that you have to consider whenever you're doing that. And it's not only the value of the property that you are buying, but also the value of the mortgage that you are buying to. And if you are good at math, you can figure this out pretty easily, but it's somewhat hard to explain sometimes. But whenever you sell your relinquished property, you have to buy a property that's equal or greater value than the property that you sold. Okay? So if I sell something for $1 million, I have to buy something for $1 million, right? Because if I don't, then I'm taking some of that money that I've made from that sale and I'm putting it in my pocket, right? And so what the IRS calls, another definition I want you to remember, it's called a taxable boot. It's the last definition on the sheet here. A taxable boot is a portion of the proceeds that you actually don't use for the purchase of the new property that you have to pay capital gains on. So again, if you sold your property for $1 million, you buy something for $900,000, and you have $100,000 you put in your pocket, then you pay capital gains on the $100,000 you put in your pocket, and the rest of it can be used for your exchange. Okay? And so the equity that you have in the property is important to know, and the value of that replacement property is important, because if you don't take advantage of those rules, then you are going to have to pay capital gains on the portion of it that you don't use. Okay? Does that make sense for everybody? Similar things can happen with debt, all right? And if you go to the next page in your example 1, it talks about how debt can play into it. So the example says if you sell something for $800,000 with a $300,000 mortgage, and you have $500,000 in equity on the relinquished property, and the replacement property is purchased for $800,000, you have a $200,000 mortgage, then you have to put up the cash, that other $100,000, in order for you to not have to pay capital gains on that property, right? Because you took some money and put it in your pocket, and you need to use that money to buy the next one. All right, so debt plays a big role in that as well. And again, this is all the things that your QI is going to help you with whenever you're identifying your properties. And so if you go, the key takeaways here is that you have to reinvest all of the equity that you have. So you have to use all the money from that sale into the next property. If you take any of that money and put it in your pocket, it's going to be a taxable boot. You're going to have to pay capital gains on that. Okay? All right, the next rule, and the rule that Whitney was asking about, is in section 7, is the same taxpayer rule. And this is where this is the last major rule that you have to go through whenever you're kept figuring out an exchange. It's also what I talked about earlier, the drop and swap strategy that people use applies to the same taxpayer rule. Flip to my thing here. All right, same taxpayer rule. So this dictates and requires that the same person that sold the relinquished property has to turn around and be the purchaser of the replacement property. Okay, so if you think about that practically, if I own a property in an LLC with Lauren, which we do, and I sell that property and my portion of the proceeds is $50,000 and her portion is $50,000, we cannot take that individually and go buy another piece of property. Our entity, that the tax ID number that was the seller of that first property, has to be the one that purchased the second property. Okay? If you sell something individually as a person or as a partnership, you can then go and buy something else as a person, individual person, but you cannot do that with another LLC that is a multi-member LLC. Does that make sense? Good.
So if you are relinquishing a property, purchasing a property, and married, okay? So just say the wife is selling the property, buying another one, 1031. Can her husband take a title with her on it or no?
My gut feeling with that is yes, because as an individual, my tax ID number that I used was the one that was buying the replacement property, even though I had a partner on that. And as long as you use all the money and your individual name is put on that, then yes, you could do that. The trick is that you could not do that as a entity with your spouse afterwards. So you couldn't sell it individually, and then me and Stephanie, my wife, form an entity that has its own tax ID number and then buy it to that entity because it's a different taxpayer. But me as an individual, if I use that money and buy it with Stephanie as a co-owner, then we can still go forward with that exchange. Okay? And so that's a good question though. And again, I think that's one of the nuances that, I've never been a proponent of standing in front of a group of people and saying and giving an answer I don't know the answer to. My response to that is I'll go find the answer and I'll let you know. But my gut reaction is based on the rule and the research I've done is that if your tax ID number, your social security number is on the purchase of the next property, even if you have a partner on that, you could do that. Now, there is an exemption to this rule. I've had this happen quite a bit of times where an individual investor owns a property in their LLC, right, that has its own tax ID number, single member LLC, and then they start a new entity and buy the property in their the new entity with a new tax ID number. That exemption does apply and you can qualify for an exchange as long as you go from single member entity to single member entity, okay? That is considered under the IRS eyes as a pass-through entity for tax purposes, and they allow you to do that as long as, again, you're a single member entity. And so all the examples that we have here are going to show you if I'm selling a property that me and Lauren own together in an entity that we own, and then I try to buy it in a single member entity after that, I don't qualify because it's two people that are now, and then another single person is buying on the back end through an LLC. So it's important to know that, and your clients to know that if they're going to sell property through an LLC that they don't own individually, those partners have to then come together to buy the next replacement property as well. So they got to continue on that business relationship going forward. Now, the exemption of this rule, which I don't know if I have it in this, the drop and swap, I do. Okay, so I've had people reach out to me. It's actually a real estate agent. They owned a building together as partners, and one of them wanted to take advantage of the exchange, the other partner did not. So the IRS has something that's called the drop and swap. And it's a very technical way of doing this, and again, the intention of the parties is very important. The IRS will allow somebody that own the property in a LLC with a partner, use it, a portion of it, the portion that maybe half of the one of the owners wants to use it for a 1031 exchange, they allow them to do that as long as the partnership takes the property, puts it into the members' personal names, and then 2 years passes with the intention of holding this property for investment purposes, and then then they come together and sell it as a partnership, and then one of them wants to go and then buy another piece of property with that. Okay, it's called the drop and swap. You drop the property out of the LLC, wait 2 years, and then the individuals can then swap those properties under the 1031 exchange rules. Very technical. The IRS is going to give a ton of scrutiny to that. Some people, what they'll do is they'll do it at the end of a tax year, file their taxes after they swap the property, wait the next year, and then the next tax year they'll do it again. So it kind of skirts around that 2-year rule just because of the way that your filing of taxes works. But again, if you get audited, the IRS is going to look at your intention, how long you owned it, whether you had lease agreements and you had a business plan and you filed taxes and tax returns, you received income, you had expenses. They're going to look at all of that stuff to determine whether you qualify for 1031 exchange.
I was gonna ask this, like, if you were in that sticky situation with a partner under an LLC, that's two people in the LLC, and, you decide that you're gonna do the 1031 exchange, it's not a good idea to do a quick claim, like a week before the sale?
No, because again, the same taxpayer rule is going to apply, and they're going to review those. If you get audited, they're going to look at the situation and say, they're going to know that you dropped the property out of the LLC for that reason to then do the exchange, and you're not going to qualify.
So you need to do it for 2 years?
You need to do it for 2 years. That's the rule. Again, if you research on the internet, you'll see people that are more risk tolerant, and they'll say, well, we'll do it in December of 25, wait all of 26, sell it in January 27. So it looks like a 2-year rule, right? Even though if you calculate the number of months, it might not be 24, but in the IRS's eyes when you're filing your taxes. But that's not a guarantee. The IRS may look at that and say, no, we can clearly see what you were doing. You didn't wait long enough. But it's important to make sure that you're setting yourself up for success when it comes to managing your business in other ways. And they may look at the situation and say, well, you made a great return. This was a great asset for you. It clearly is in business purpose. And it just depends on who comes knocking on your door with the IRS black suit and black sunglasses on. All right, so again, key takeaways. You got to make sure that you're paying attention, that you use the same owner. The ownership structure is important. Disregarded entities like single member LLCs will work for a 1031 exchange if you want to buy it in if you want to sell then buy in 2 different entities. And then the drop and swap is a potential strategy that allows somebody to drop the partnership interest, put the property in their personal name, and then do an exchange. But you have to meet very, very strict guidelines. And so you want to make sure that you're setting yourself up for success in that. I'm rolling, guys. So we're definitely not going to take 2 hours on this. But advanced strategy. Go ahead, Karen. Good. Wasting some time.
Question about the title.
Yeah.
So the titles hold, like after you sell the property, how does that title going to be?
After you sell it?
Yeah.
Yeah, so the property is going to be, the sale of the property, obviously when you sell it, it's going to go into the buyer's name, and whenever you buy the replacement property, you'll put it in your name. The key is just the money is not in your pocket.
Yeah.
Right. Now there's an advanced strategy we're going to go over called a reverse exchange, which we'll go over in a second, which the title to the property will make a huge difference when he talks about a reverse exchange. Somebody said my name. Okay, so 3 advanced strategies we're going to go over with today. Somebody had a question? No questions? Okay, 3 advanced strategies: the consolidated exchange, the reverse exchange, and the 1031 exchange for installment sales. Okay? These don't come up very often, but in some instances, I had an investor that reached out to me the other day. We were very close to doing a reverse exchange, but we didn't need to do it. But it's a really cool strategy. All right, so the definition of a consolidated exchange involves the selling of several properties in order to take advantage of a 1031 exchange. Okay, so this may look like an investor that has a portfolio, and their goal is to simplify and go from having 8 doors across 3 states to having 8 doors in one building in one place, okay? And so the goal in this scenario would be to allow a real estate investor to, again, be more efficient with their money. We skipped that one. We'll go straight to reverse exchange. I'll get into consolidated exchange in a second. A reverse exchange is a second type of complex tax-deferred exchange. And what this allows somebody to do is to buy the replacement property before they sell the relinquished property. Okay? And so sometimes people will come up and find a great opportunity for them to be able to buy something that they want to buy, and they think, okay, well, I have the ability to buy this maybe with cash, but I also want to replenish my cash, and I'm going to sell a piece of real estate. And then in that sale, the IRS will allow you to take all that money and put it back in your pocket, assuming that you were using that you would have used it for the other property had you sold that one first before you bought. Okay? It's a complex strategy, and a qualified intermediary is really, 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 really important in this scenario. So, yes?
What's the time frame they give you on the reverse?
Same exact time frame.
6 months?
The 6-month period says the 45 days and the 180 apply. So to be specific, once you buy the replacement property, you have 45 days to identify the properties that you own that you want to sell, and you have 180 to sell those properties you've identified. Okay? Is that cool? That sounds cool to me. So some of the requirements, again, is that you have to have a qualified intermediary involved. And instead of the qualified intermediary setting up a bank account with your name on it to hold the money, they're going to set up what's called an exchange accommodation title holder, also referred to as an EAT, which is really cool. John says the word eat all the time in the office now. They've been setting up this. And John doesn't eat a lot, which is, you can tell that, blow him away. So the reason why an EAT is needed is because the IRS requires that the property doesn't go into the seller's name until they've sold the relinquished property. Okay, so that's the key. Again, if I go sell a piece of property, if I buy a piece of property and I put it in my name and I want to do a reverse 1031 exchange, once it goes into my name, I cannot reverse that. I cannot qualify for a reverse exchange. You have to know you're going to do this before. And the qualified intermediary is going to set up a unique entity for you. Again, why you need to make sure that you think about this beforehand. You got to make sure you reach out to your qualified intermediary before, because they've got to go through the formation process with the Secretary of State to form this entity. And the entity is going to be built just for you to hold the title to this property until you've sold your relinquished property. And so these are the steps on how you do that, right? So you establish the EAT, you acquire the replacement property, and you're going to put the property into the name of that EAT, and you're going to use your money to do that, right? So if you're buying a property for $1 million, you're going to have to pay $1 million in cash and buy that property, right? And the property is going to go into your EAT's name, and you have to identify, and you meet the same standard, right? 3 property rule, 200% rule, 95% rule on the properties that you're going to sell, and you have 180 days, which is the time frame, in order for you to fully fulfill that exchange process. Okay? The process cannot take longer than 180 days. Okay? That makes sense? So again, in our scenario, I again nailed it on the head. Somebody bought a property for $1 million, and then she had to go and find up to $1 million of property to sell, and she could identify 3, or she could use the 95% or 200% rule and accumulate several properties that she wanted to sell in order for her to be able to qualify that and meet that exchange deadline. All right, and we're going to get into the consolidated exchange. All right, so the second complex tax-deferred exchange is a consolidated exchange. And what we're going to do with this is we're going to take a portfolio of properties, or at least more than one, that we own that we're going to sell, okay? And again, you talked about the complexity of a traditional exchange and the timelines and all the things you have to meet and the risk associated with that. These consolidated exchanges are equally as complicated or more, because you not only have to do all of those things within the time frames with one property, you have to do that with several. So if you're going to do a consolidated exchange, meaning I'm going to sell 2, 3, 4, 5, 10 of my properties, I have to have sold those properties, and on the sale of that first property, your timelines start. So when you sell that first property, you have 45 days to identify, and you have 180 days to buy from the date of the sale of that first property. So if you plan on selling 3 of them, the IRS is going to calculate your time frame based on the first one that was sold. If you don't do it within the 45 days or 180 days of the first property sold, that one you're paying capital gains on, you go to the next one, right? And so I've had a real estate investor reach out to me. He sold several properties, one in New York, one in Florida, wanted to buy something in Texas. He sold he sold in Louisiana and New York, wanted to buy in Texas. And so we closed on the one in Louisiana. Somebody else closed in New York. We took the money, put it into our qualified intermediary account. He did those transactions relatively close together, identified a property he wanted to buy, which is in Texas, and we closed on it with 180 days. And he got to defer the capital gains on both of those sales to buy another piece of property. Okay? Again, it's important to know that your attorney's on board, your title company's on board, your CPA's on board, and your real estate agents all understand what you're trying to accomplish. This person is not the most organized person. So it was Sunday of Mardi Gras weekend, and he text messages me and says, "Hey, I'm selling this property in Washington, D.C., and it's closing on Monday, tomorrow, on the day that we're all closed." So me and my paralegal on our escrow company were working on Monday for Mardi Gras and then didn't do the exchange. But we were available to try to do it. So it's important to make sure that you're organized and ready to go for that type of stuff. All right, the delayed exchange, that's again, the same as a qualified exchange, just another way of saying it. And then, we skipped I don't have the installment sale stuff on here. So before we wrap this up, which I knew it was gonna take me an hour. Y'all are getting a bonus hour out of this. The installment sale. So this is for your seller finance transactions, right? That's considered, it's called an installment sale with the IRS. So that means you're seller financing something to somebody, all right? If you're going to seller finance something to somebody, you can technically meet the standards of a 1031 exchange. So think about this practically. If I'm selling something to somebody on owner financing, I'm only getting a portion of that money in my pocket, okay? They're going to pay me the rest over time. So in the IRS's eyes, I'm not going to be able to take all of the gain from that and apply it to another transaction. So what the IRS is going to require that you do is they're going to require that you can self-fund the entire transaction. So you're going to put the money for the sale for the whole sales price. So let's just say the sales price is $200,000. The IRS is going to require you as a seller to put $200,000 in the qualified intermediary's account. Then you can go to do your closing for the installment sale. They'll allow you to put a portion, the down payment in your pocket and start collecting over time. But you use the money you put into that qualified intermediate account to buy the replacement property, and they'll allow you to go through and assume that that whole transaction was deferred. You don't pay any capital gains on any of the money you put in your pocket for that installment sale. Does that make sense? I know it's a very complicated situation, but if you have a client who's got an opportunity to do something, seller finance and an installment sale, you can still take advantage of an exchange, but it's very, very important that you pay attention. On the front end, you make sure that person has the ability to self-fund it. I'll tell you a situation that some of y'all in the room, I won't say who it is, will know these people that I had to deal with. It's actually somebody in Hammond where they wanted to do a 1031 exchange. They seller finance something to a buyer, and that buyer had not, the way that the release was written by a lawyer in Hammond, that wasn't me, wrote it as a bond for deed, but then in the actual terms of the agreement said that there were lease payments being made, okay? And those two differentiating factors are very important because a lease payment means that the property hasn't been sold. There's a tenant-landlord relationship, right? But on a bond for deed, the IRS looks at that as the possession is being put into somebody's name, and even though title hasn't transferred, the IRS sees that all the beneficial interest and rights of ownership have passed, and they consider that a sale. So technically, if you remember all of our timelines, that under a bond for deed or a credit sale, the moment from that closing happens on that bond for deed or credit sale is when the time frames start. I got called 2 years after they made that agreement, right? Well past the 180 days. Would not have qualified. Well, because that agreement had lease payments in it, we were able to amend it to say this is a lease with the option to purchase, so that later on down the line, if they decided to make the option, or to trigger that option, that they would be able to buy it at that point and have all the lease payments qualify towards money towards the principal balance. So it functioned similar to a bond for deed, but it was actually a lease. Because again, the trick is on a bond for deed or a credit sale, if you want to take advantage of the exchange, the moment that that agreement is signed is whenever those time periods start. Not whenever the buyer pays off the person and the money, the bulk of the money goes in their pocket, but when that first transaction happens. Does that make sense? Well, that was complicated, but it's, again, the point of that story is to say, one, there's always a solution for things. But the second thing is that getting in touch with your people early and letting them know what you're doing and talking about this before you get started, and especially when you're doing a $3 million, $4 million transaction like these people were, that you're paying attention to all those deadlines and you're making sure you're meeting all the standards and guidelines.
How costly is doing a 1031 exchange?
How much do we charge for 1031 exchanges? For a traditional exchange, we're between $1,500 and $2,500, and we say that because if you come to us the day before closing and say, I want to do an exchange, surprise, we're probably going to charge you a little more because we're dropping everything we're doing to make sure you're taking advantage of that. If you let us know early enough in the process, $1,500 for the sale of the relinquished property, and then we're going to charge you $500 for every time that every property you buy. So if you follow our rules and you buy 3 of the properties you identified, we're going to collect $500 on each one of those. It's just from an administrative standpoint. We got to open accounts and do all these things for people. A reverse exchange is going to be more expensive because we're having to form an entity and we have more liability when it relates to that because we're holding title to that property. And so it's important that you understand how capital gains work, because if you're only paying $5,000 in capital gains because you have a long-term capital gain and it's 10%, right? It might not be worth doing an exchange. But if you're making $100,000 in capital gains and your tax liability on that is, $15,000, it might be worth doing an exchange and saving some money. So, yeah, separate from title fees. That's qualified intermediary escrow fees, and that's competitive. But First American Exchange does a great job. They're in town. We've compared prices with all of them, and it's a similar price to them. But the reverse exchange and the installment sale exchange, it's just complicated. So we have to charge more for those things. But it's all a numbers game. You got to make sure you know that you're going to be saving the money from taxes, and that your costs for that are not going to be too expensive. Anybody else have any more questions? Who wants to do a 1031 exchange now? Raise your hand. All right. Look, all these guys up here that talked today, these real estate investors, like they're thinking that, especially Drew. I mean, I know that they talk to y'all generally. Sam and Scott Matthews and James Wells, they're buying a lot of volume. Karen, not to leave you out. Karen Belindia right here, she'll raise her hand in the front. She's a real estate investor too. Get to know Karen. And so she works with a lot of the guys that are up here, coincidentally. But being a single family flipper, wholesaler, investor, they don't have as many opportunities for 1031 exchanges. But Drew buying these buildings that he's converting into storage facilities, like he takes advantage of 1031 exchanges whenever he's doing real estate deals all the time. And so you talk about adding value to them, making sure that like if he's a 1031 exchange guy, we got to timelines meet. We got to make sure that we sell and buy stuff within the time frames required. Yeah, go ahead. Steve, I'm coming to you, buddy. Yeah, if you tell us 2 weeks in advance, there's plenty of time for us to get our ducks in a row and not have to rush. Say it again? Yeah. Yeah. I would say, like, once you get under contract, a traditional 30-day contract, if you let them know when the property goes under contract, plenty of time to take advantage of a 1031 exchange and even consider it. And I mean, look, if somebody is considering an exchange, the key thing that I said, right? The money can't go into their account, or the title can't go into their account if they do reverse exchange. So in some instances, it's worth seeing what the opportunities are to put the money into a qualified intermediary's account. Give yourself the ability to have 45 days to try to identify properties. There's no cost once beyond the setup of that. And then if it doesn't work out, then you put the money in your pocket, pay the capital gains on it, and move on. But at least you gave yourself the ability to potentially do it. Because once the money goes into the account, you're out. Yes, Steve?
I want to make a point that this is a real good reason to contribute to the Political Action Committee with your Board of Realtors, because the federal government over the last several years has been attacking the 1031, either wanting to reduce or do away completely with the 1031 IRS code. And if that were to happen, a lot of major investment projects with shopping centers, apartment complexes, and things like that would go away or not happen as cost effectively for the consumer. So that's another important reason to contribute to the PAC with the Association of Realtors.
Yeah, we don't want 1031 exchanges to go away. I mean, as they were saying up here too, as a real estate agent, to take advantage of a real estate investment opportunities for yourself, it allows you to level up your real estate portfolio without having to pay capital gains and being able to use more money, have more buying power, so you can buy bigger and better properties. And then ultimately, with the exemption we talked about, stepped up basis, that's how these wealthy families are able to take this money and recycle it and keep it and not have to pay a big tax bill. It's because they know these rules and they're applying these rules and they're using them to their advantage. I'm milking this down to 50 minutes so that I can say that out for an hour and 10. Anybody have any more questions? All right, before we leave, my team outside, Lauren just walked that way. I'm gonna get her to walk back across the room and go get everybody to get our sheets of paper. Make sure you sign out so I can give you your hours of credit today. And two things, we are going, the bar's open, so y'all stay and hang out and network. Trey, if you've never heard Trey play, he's enjoyable to listen to play the guitar. And bingo night is tonight. So I always overextend myself. We're gonna be hosting bingo night and we're gonna be giving away things at bingo night tonight. So if you want to stay or come back and do bingo, it's a whole lot of fun. I'm going to ask that once y'all get up, that y'all don't linger in here for too long. Get yourself a beer and go outside, because I'm going to pick up all these tables in the next 20 minutes and move them out so that they can have bingo night. So look, I really appreciate y'all coming. If y'all have any feedback, let me know. We're going to be planning next year's CE probably next week, just because we try to get ahead of things. We want to add value to you guys. So anything you want to hear, let me know. I'll get them set up to come next year. Thanks for coming, guys. Appreciate y'all.